Portfolio maintenance. So you've already decided on a diversified blend of asset classes. Now you just need to know, when should you implement that strategy? When should you make changes to it? Or when should you just sell out or cut your losses, or switch your investments around? So buying, rebalancing, and selling. These decisions can be just as hard as deciding what to actually buy in the first place. But we've all watched the stock market go down, right? And you may be thinking, well, I know I want to buy in, but why don't I just wait until it keeps going down a little bit more? Because I don't want to, buy in and then suffer immediate losses. It's really hard to time that exactly right. And I can go ahead and tell you, you're probably not going to time it just perfectly. It's very rare to do that. In the same token, if you're watching it go up and up and up, you may feel like you're missing the boat, and you may be kicking yourself for not buying in a week ago when you could have. Well, I know both of those feelings very well. So one solution that some people like to do is called dollar cost averaging. In the text I describe it, it's basically like taking, if you had $100,000, you may take $10,000 a month or a week or a quarter and buy in at the same amount for the same interval until you got everything invested. Now the downside of this is it's going to take longer for all of your money to fully be implemented into the strategy. And remember, this strategy is something that you've already decided is kind of in your best long-term interest, and it's going to take you maybe a year, maybe longer, depending on how far out you spread the intervals between buying. So it's just going to take you longer to buy in. However, it does have the effect of averaging out the different buy-in prices. So if you're worried about timing it on the low side or on the high side, dollar cost averaging is a way of kind of spreading that risk out. And I do think it's better than just holding tight and not investing at all. However, once again, it still may not be the greatest thing, because let's say if you're dollar cost averaging and the market just keeps going up, well, you could have bought the whole thing in. You could have put 100% of it in a year ago when you started dollar cost averaging, and instead you're averaging to the upside, so your average price ends up growing. Now the negative could be true. If the market had been tanking and you were dollar cost averaging, then you keep buying it on sale. My view personally is that if you figured out that an investment strategy is in your best interest for the next 5, 10, maybe even 20 years, just buy into it. If you can't do that, if you want a DCA, go ahead. I typically don't do dollar cost averaging, because if I know something's in your best interest, if I know something's in my best interest, I'm just going to buy into the strategy because I believe in it. And sure, you may take a little hit in the short term, or you may come out a winner in the short term. We don't know, but you're not really buying it for the short term. You're buying it to reach your mid to long-term goal, and that's what's important, not some short-term win that may or may not happen. So that's my view on dollar cost averaging. When should you buy it? You should buy when you know the strategy is in your best interest and when you believe in the holdings for the long term. Then you should just buy. That's my view. All right, so rebalancing. Rebalancing can be a very good risk management technique, but it may not be something that's just good blanket-wise for everybody. And that's because you may just end up trimming your flowers to water your weeds. So rebalancing really is just taking from your recent winners and taking some of their gains and selling them and adding to your recent losers to bring them back up to where you started. So it really just brings your portfolio back in line with how you originally intended it to be. And naturally, you're going to have some winners and some losers, and rebalancing is just kind of cycling those back to where they were, maybe capturing some of those gains, buying some things on sale. Some people view it as, well, you're selling high and you're buying low, but it just kind of depends. If you have a stock or a certain asset class that just keeps going up, 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 and you keep trimming it, then you're really just kind of stunting your growth, potentially over the midterm or long term. So you're stunting your growth. So over the long term, stocks do outperform bonds on average. So if you keep rebalancing, then naturally you're kind of trimming some of your stocks and buying more of your bonds. And this is good for risk management because it does stabilize your portfolio and keep it to where if you started with a 60-40 and you kept rebalancing it, maybe quarterly or annually, then it would continue to go back to a 60-40 model, where if you never rebalancing it, then it would drift. So it could drift to a 65-35 or even a 70-30 model over a number of years. It could drift, which may not be in your best interest anymore, especially if you're nearing retirement age. So if you're worried about risk management, if you're really investing for retirement and trying to stabilize your portfolio, then rebalancing is very important in my opinion. But if you're just trying to grow your money, if you're still in the growth phase of investing, then rebalancing could just be taken from some of your winners unnecessarily. So you may not want to do it in that case. All right, so the third thing here is active trading. How much should you trade? How much should you change things? And just in general, when should you sell something? So if, let's say if something's down, there's obviously the natural inclination to want to get rid of it. Let's just cut our losses and sell it, right? Well, that depends on if it's down because of just a cyclical trend. If, let's say, if the sectors are kind of moving at different paces and some sectors are rising, some sectors are down. So if you're just selling the sectors that are always down and trying to buy back into the sectors that were recently up, well, you could end up kind of selling something that was about to pop and go back up, and keep selling and keep buying into the thing that's really stalling and about to go back down, because these sectors, they kind of ebb and flow at different times. They kind of take turns being the winners. And if you just keep selling from the one that had gone down and buying from the one that had gone up, then you really just kind of keep riding everything down, and that may not be a great thing. So studies show that the more people mess with their portfolio and the more you make changes to it, the more you adjust it, the worse performance tends to be. So there you have it to some degree. You don't just want to start tinkering with it too much. Sometimes when you try to outsmart it, you could end up getting yourself into trouble. I think it's best to make sells and to make adjustments based on two factors. So the first is, if there's something that's changed in your personal goals or your personal planning needs, or maybe your income needs, then changing your strategy or changing some of your investments to fit your new needs and your new goals is usually a prudent thing to go ahead and do. So that's a good time to sell. The second one is more specific to the actual holding. So let's say that you were buying individual stocks or individual asset classes, and for some reason you've decided that the long-term thesis, your belief in this holding is gone, regardless of what sector it's in. Yeah, sure, the sector may have gone down, but regardless of the sector, if the long-term thesis, if you just don't believe in it anymore, then maybe you should go ahead and cut your losses. So really it's that long-term view. It's not a cyclical trend. It's just that you don't think that it's gonna go back up. It's kind of like years ago we had a lot of people had BlackBerry devices, and then the iPhone came out and people were kind of migrating to that approach. So if you don't believe in the long-term vision of BlackBerry anymore, if you don't think that they can get their act together and kind of rally back up and come back, if you don't believe that that's going to happen, or if you don't believe they can pivot their business to something else that's going to add value to their shareholders, then that may be a decision or a time to potentially trim that loss from your portfolio. So it's really just something that's specific to the company or the industry that you just don't believe in anymore for the long term. Then that could be a good idea to go ahead and trim it for your portfolio. And yes, taking a loss kind of stinks, and all of us, we don't like to take losses. Sometimes you hold on to something until it comes back. You're like, yeah, I wish I could just get my money back from it. I want to just hold it until it comes back, and then I'm going to sell it. And then it never comes back, and you just keep getting deeper and deeper losses. If you don't believe in it anymore, then it may be a good idea to go ahead and cut your losses. I did hear one commentator say one time, which I thought was interesting. He said, imagine that you went to bed one night and all of your holdings were sold. You sold everything. Everything was completely liquid again, cash in your portfolio. The next morning, when you woke up, would you buy into the exact same holdings with the exact same amount of money as you did the day before? And if there are some holdings that you wouldn't buy in again, even if it had gone down, then that'll tell you something just internally about how you feel about that holding. So if that's the case, it may be time that you don't believe in it. It may be time to go ahead and trim it from your portfolio because you don't believe in it anymore. So that's something I've used mentally to say, you know what, am I just waiting for this to come back, or do I just not believe in it anymore? And if I had it in cash, would I buy it again? Probably not. Well, maybe I should just go ahead and put it in cash then and not worry about the loss. So that's just a little nugget on maybe potentially when to sell. So we've talked about when to buy with dollar cost averaging, or by just go ahead and fitting it with your strategy. Rebalancing, again, should fit with your long-term goals and your overall strategy there too. And when to sell, again, you're going to sell based on your planning goals and your needs, or if you just don't believe in something anymore. So those are some tips on maintaining your portfolio for the long run.